Hello viewers, welcome back to 9th episode of AKC Capital's financial podcast series. I'm your host Shweta. Joining us once again is AKC Capital's founder and director Mr. Aditya K. Chopra. This month we are talking about equity markets and long-term wealth. And today's topic is SIP versus lump sum. So which strategy wins? Imagine you have just received bonus of 3 lakh. Should you invest entire amount at once or invest it gradually through SIP? It's a question for many investors, right? And the answer may surprise you. Let's find out. Welcome Aditya. My first question is, what is the basic difference between investing through a SIP and investing a lump sum amount?
Interesting question. So an SIP is basically a systematic investment plan, which basically means that you are investing a fixed sum of money regularly every month, vis-a-vis a lump sum where you would invest the entire money at a single point in time in one shot, right? And SIP typically has a monthly frequency, and there is a auto debit to your account, and it typically a fixed amount gets invested month on month and on a regular basis. So what essentially is the basic difference between the two? While SIP follows something which is called rupee cost averaging, right? And SIP continues, since it's an automated process, right, with a debit to your bank account. So you are investing irrespective of the level of the markets. When markets go down, then for the same quantum of SIP going in that month, you end up having higher units, and when markets are going up in a month, then at that point in time you would proportionally get lower units for the same quantum of investment. So essentially it averages out your investment over a period in time. Lump sum, at the other hand, requires one to really time the markets, which actually is very difficult, and statistically even professional fund managers can also not time the markets. So this is where the basic difference between the two would be.
Okay, can you explain this with simple example? How do the numbers compare between a SIP and a lump sum investment?
Yeah, I think, Shweta, that's an interesting question. So let us assume a corpus of 10 lakhs. So if a person were to invest that in a single shot, and let's say the market, the NAV of each unit is 150 units, he would roughly get around 6,667 units for that price. And let's say if the markets were to correct to by 20%, then his investment of 10 lakhs would eventually go to 8 lakhs. And generally what happens in such instances, investors tend to panic and exit. So you see he actually has a realized loss of 2 lakhs. In a similar scenario, a person invests, let's say 50,000 per month for the next 20 months on a monthly basis. So he's invested in total 10 lakhs, and during this period his average price per unit is around 135 rupees per unit, and he gets around 7,407 units approximately. So now when the market recovers, you see the investment actually here becomes 11.1 lakhs vis-a-vis 10 lakhs vis-a-vis 10 lakhs in the former case. So an SIP investor is actually better off by 1.1 lakhs gains. So what we're trying to say here is that there is futility in market timing. You follow rupee cost averaging and let your money get invested. So eventually you will get that long-term average, which is beneficial, and you will see that your overall portfolio has a better compounded annual growth rate.
That's really interesting comparison, Aditya. But is there ever a situation where investing a lump sum works better than a SIP?
I think that's a good question, Shweta. So when does lump sum outperform the SIP? So essentially the answer lies is whenever the markets have hit the bottom, right? And The two examples in recent memory is March 2020 and then also in around the same time in 2008, the subprime crisis. So when the markets hit the bottom, and if you really had cash at that point in time and you invested, so obviously in the recovery phase you will make a lot of money. But here's a catch: how do you really identify when the bottom is? Because if you felt that the market has gone down by 20%, well, it can go down further by another 10-20%. So identifying or timing the bottom is nearly impossible, right? And nobody has mastered this art. So and the other point which we have seen in a longer period of time, that even if you got the bottom right, what is the guarantee that you are sitting on cash at that point in time? So there is a bottom, and suddenly if you don't have cash, you will miss it anyways, because so it requires that the market timing for the bottom has to be precise, along with the fact that you should also have adequate liquidity to put back in the market at that point in time. Statistically, getting both of them is nearly impossible. So what we have seen is that over a long-term 15-year average, SIPs tend to outperform lump sum investments 70% of the time. So I still feel that instead of timing the markets, just have the right asset allocation and do your investments in SIP route in a regular manner and book your profits on time.
Let's end with a practical question. Suppose I have just received a bonus of 3 lakh. What would you recommend? Should I invest the entire amount right away, or is there a better way to do it?
Well, I think that's an interesting question. I think we need to look at it in a holistic manner, right? So if one suddenly gets the bonus of 3 lakhs, I would suggest that you park it in a liquid mutual fund, which is probably giving you 5.5-6%. So immediately your lump sum money is actually earning interest and working at a certain rate. And then what we could do is that do something which is called an STP, or a systematic transfer plan. And in this case, one could do, let's say, a monthly STP over 12 months, which works out to be 25,000 rupees per month, and wherein that money is going into an equity diversified fund. So this entire corpus gets deployed into long only equity assets or an equity asset fund over a period of 12 months. And essentially what a systematic transfer plan is doing, it is doing the same thing, which is rupee cost averaging, which was there in a systematic investment plan. In a systematic investment plan, there is a debit mandate, so your bank account is automatically debited on a monthly basis. A systematic transfer plan is a client authorized transaction where your liquid fund gets debited and your corresponding equity fund gets credited at regular intervals. We have seen that monthly STPs are fine, but if you want more granular allocation, you could even go for options like a weekly STP or a fortnightly STP. Either ways, you will get the rupee cost averaging, and what you will notice is that your portfolio gets deployed and it will give you much healthier IRR in the long run. So this is what we would suggest in such a scenario.